Michael Finch, my dear friend, thank you for joining.
Dalton, thank you for having me. Appreciate the time.
For sure, you and I, very fortunately, we've been on some webinars in years past. I think maybe we've been on a panel together here or there. Who knows? Our paths cross constantly, and very fortunately. So, give the folks of the real estate of things some quick background on you and SVN.
Yeah, happy to, and yeah, thank you all for listening and watching. My name is Michael Finch. I'm the executive VP of three companies here, and I'm principal founder of our three companies. Our first company is SVN, SFRhub Advisors. That is a national commercial real estate brokerage, 100% focused on the SFR and build for rent asset classes. Literally all we do. We don't do multifamily, retail, office, industrial, hospitality, or the typical CRE assets. We operate nationally. We currently have listings in 25, 26 states right now, and a lot of opportunity forthcoming as well. We're bringing on some good new deals, so keep your eyes posted on that. Our second company is SFRhub.com. That is a data research valuation technology platform that we capitalized several years ago, and it's really kind of the spine of everything that we do. It enables us to underwrite accurately and efficiently, clean and verify data, and more closely find what the true retail value is of any home within a portfolio, and then aggregate each individual home to that portfolio aggregate price. We've underwritten almost $50 billion of single family and build for rent deals at SFRhub.com. And on the BFR side in particular, BFR meaning build for rent, we do a lot of consulting out of SFRhub.com. We've been working with developers and builders for a year, helping them to think through how to value a build for rent home, how to optimize it, whether or not amenities are needed, right sizing the lots, creating the right floor plan and unit mix for, an investor's perspective with, cash flow in mind, and really how to optimize an NOI. It's a commercial real estate investment asset class now. And, the builders traditionally for the last 100+ years, they've been building for sale. So it's a different product and there's a bit of a learning curve, but our two worlds are colliding, so to speak, the residential and the commercial here within the SFR and BFR asset class. And now that it's a known institutional asset class, SFRhub.com has been really leading the way in valuations, research data, and more recently, last few years, a lot of consulting. And we've teamed up with some of the industry leaders on some of those as well. Some of the big groups that you might know, Hunter Housing Economics or John Burns. So that's our second company, SFRhub.com. And then SVN, SFR Capital Management, that is our third company. That is an investment firm, an asset management and operating company that's aggregating build for rent communities currently around the country, mainly in the Sun Belt. We've got a number of deals under construction and under contract today, and we're very excited to be working with one of the nation's best equity groups that's been heavily involved in the single family asset class today as well. So plan with SVN SFR Capital Management as an asset management and operating company is to acquire 35,000 build for rent homes within self-contained communities around the country, specifically focused on build for rent.
Yeah, a lot there, and truly in the space of single family rentals, it's tough to find a group that has the level of expertise that you and the crew do. So, that said, I want to jump right into it and start picking your brain. You and I were chatting before the call, just kind of comparing notes of the last couple days and weeks, and talking 2-year swaps and everything fun there. But on the value side of the fence, talk to me about discovery on retail values. Right, we have been up and to the right since COVID started. That the winds have changed on that, right?
We
We're
certainly have.
yeah, like a flat and declining market. So how's that affecting and more specifically, like, are you already starting to see particular pockets getting materially hit?
Yeah, I mean, we've been the last couple months, and the Fed just raised the rate again, as I'm sure everybody knows, another 75 bips. But we've been spending a lot of time educating sellers on listings that we had, prior to, the rates really starting to explode in July through today, as well as educating groups that are interested in selling today, or that have been in the last, call it 60 plus minus days. And what's everything's lagging today, right? So 9 months ago, there was no worry. We would value, and we still do today, we value every single home in a portfolio that's coming in at the retail price. And 9 months ago, if we had a 100 home portfolio, say, and the average retail price was 300 grand and it was a 4.9 cap, that was a sellable deal. That's not the case today. So what we're doing, and really having to educate potential sellers on, is, hey, we're going to value your portfolio at where the suggested retail price is today, based on comps, based on quality of home, all the things that go into it. But at the end of the day, if that aggregate retail price of all 100 homes in a portfolio is, say, $20 million, but the return is the stabilized return on current NOI, if that's a 5 cap today, it's a real conversation that we have to have with the seller, and get them educated on where the buyers are going to need to be, because that wasn't a concern before. It was always retail, and if the returns worked out, or if there was some value add where a buyer could quickly see that they could get north of a 5 cap, we knew it was gonna sell. And that's, in the A and B class, sort of arena. C is moves that bips up a little bit on returns, but today it's totally different. We've got interest rates going near 7. I mean, we've been getting quoted 6.5, 6.75, a month ago, and now we just had another rate hike. So mortgage rates are going to 6 plus. Conventional terms, on these loans for portfolios, they're higher than that. So it takes a lot of time. If the retail price shakes out to a 7.5 cap, great. We'll go to market on that. If it doesn't, then we've got to have a real conversation with the seller on where the pricing needs to be for the portfolio. So investors, which I think 95% plus of all buyers are using leverage, so that they're all held to essentially similar standards. Obviously, certain sponsors, may be able to put more down, or have greater scalability, which is a little less risky for a lender. But at the end of the day, they've got to be able to get a return to purchase a deal. And if it's a 5 cap and somebody's being quoted 6.75, interest rate, how can you make that pencil? So it's been a lot of educating lately, and the good news is that we've been successful in that in the last call it 6 weeks, and we've got a number of deals coming in that do have higher cap rates that are going to get attention. And there's no denying that the SFR and BFR market is a great hedge still, and a great mitigation of risk compared to other commercial asset classes. There's a shortage of homes, and rents are staying strong. Values they're not precipitously dropping today because it lags. But I think I think 2023 will probably see a 15% decline in values nationally. Different markets are going to be different, of course. Some like Phoenix, where we're headquartered, we've had some of the highest price appreciation year over year of any other market in the country. So maybe that pullback is going to be a little bit greater. Nobody has a crystal ball here, but homes aren't selling, and whether they're new construction or on the MLS, because you either can't get the loan or people aren't sure if prices are going down. So it's just going to take some time, for everybody to kind of figure it out. And what was the second part of your question, Dalton?
So I want to touch on one thing you mentioned, though, the home supply piece, right? That definitely is playing a big role in blunting, or rather stunting, the effect of the depreciation that's happening, right? Like, if not for the inventory issue and lack of inventory, it might be, who knows, but maybe double the drop off. Definitely a more precipitous drop off the edge of the cliff, right?
Yeah, I mean, on resale homes, it's, in my mind, values are, I mean, everyone knows that values are coming down, but a large majority of homeowners have locked in rates sub 5%. I think it's like 85% of homeowners have sub 5% mortgage rates, and a good chunk of those are around 3%. So unless they have to move cities for a job, the odds of them being a seller right now are pretty unlikely, because what do they buy? The prices right now are at arguably at the height of the market, and everybody's expecting them to fall, and so I think the resale supply is going to stay low because of that. The only people that will likely be selling are those that probably need to move for some particular reason, or maybe there's other life situations that I couldn't possibly foresee, but I think that's going to keep the resale MLS supply fairly low, which is again going to kind of slow down how we see that fall. And it's probably just going to show up in a couple months, and we'll have a better idea of where that decrease is. And it's not drastically different on the builder side. There's tons of standing inventory out there now, but most of the publics and large regionals are slowing down on going vertical on any new lots, because they're already sitting on a good chunk of standing inventory. I think Allie Wolf was on Bloomberg the other morning and mentioned, KB has seen a 50% decrease in contract sales, over the last couple months. Lennar, she said, was at 12%, but that was because they've been, offering pretty significant incentives, cutting their base pricing, in an effort to, keep selling homes. But, there's going to be some standing inventory out there, it looks like, for a while, because we've been onboarding thousands of homes where the builders are saying, hey, do you think investors will buy these for rent? And they're all over the country. But some of the problem with buying some of these homes for rent, even with a 20%, maybe even 30% discount to the retail price today, is that, these homes weren't ever thought to be rental products. So they're 2,500 square foot, 3-bed, 2-bath homes with very high-end finishes. That is a challenging product type for an investor to rent the home, because a renter doesn't, unlike a home buyer, a renter isn't looking at or willing to pay more in rent just to have more space. And it also, for an investor's perspective, thinking about the future of CapEx and turn costs, to retrofit it back to more durable finishes, is cost prohibitive. So, I think it's going to take a little bit of time, but there's 100% going to be value depreciation both on the resale and on newly constructed homes.
Yeah. So how do rents play into this? Or where do you foresee rents going? Do you think it's going to stay flat, or do you think the um, more prohibitive nature than we've had earlier in the year for home buyers in terms of prices, rates still being high, even if they come down some on the price side of the fence. Still, the appreciation in the last 2 years has been astronomical. So homes are
Yeah.
still going to be relatively expensive when you compare to 12, 18, 24 months ago. So what do you see on the rent side of the fence?
Well, I think therein lies some of the silver lining here for investors, and even going back to our previous point about a homeowner that has locked in low rates and may not want to sell, but if they have to move and sell their home today, the opportunity I think in that situation is to move into, let's say they're moving from Phoenix to Dallas, find a home to rent. It is significantly more affordable, even with high rents, to rent a home today than to own a home. And with the current, prior to the rate hike this week, the average entry level home mortgage was $839 higher than renting that same home. Now it's going to be north of 1,000. No ifs, ands, or buts about it. I don't know where it's going to shake out, but it will be north of $1,000 difference, or right around there. So for those that need to sell, they should look at renting for a while and just get comfortable in the market. Get the lay of the land where you're living. But it's also cheaper to rent than to own. And for investors, that the investor concern is always about catching a falling knife, right? And nobody wants to buy when prices are going down. But this SFR market is unique because, data going back to the 80s shows that the SFR, the single family rental market has held up better than any other asset class in the country, when we're going through recessionary periods. And I wouldn't think we're in a recession right now. And I'm talking the macro economy, but we're certainly in a housing recession right now. I mean, I think nobody would argue that we are in it. It started. We just don't know where the pricing is going to go. But that being said, values are going down. Builders are offering greater discounts, and home buyers are also going to have to reconsider, their price of a home 2 or 3 or 4 months ago is now going to be below that if they want to sell. So there's opportunity in that regard to buy homes where values are going down and rents are going up, and rents are still projected to go up over the course of the next several years, and largely due to a lack of supply on the market. There just aren't homes to rent. So, and if people aren't buying homes, they're likely renting homes, because families aren't typically renting, 1 and 2 bedroom apartment units. So they're going to be looking for single family homes. And I think John Burns indicated recently that, year over year, effective new lease rents are still moving at 6% up today. And a lot of the major markets are still projecting a 4 to 6% rent increase year over year through the end of this year. And I suspect, and based on some of the data that I've read, I think it's going to normalize a little bit, that rent growth, in that 2 to 2.5 to 5% range, but really probably averaging around 3, which fits into, kind of the typical pro forma you should be putting together conservatively on rents anyways. So I don't think we're going to see the exceptionally high rent rate increases that we've been seeing, but all numbers across all 99 of the major markets in the United States are still indicating rental rate increases. So if you have the ability to, to buy prices while they're going down, and you can still lease them at increasing rent rates, it's an opportunity. So for the capital, I think out there, in regards to catching that falling knife, I personally don't think it's a good idea to wait until the absolute bottom hits, because maybe today you can buy a 6.5 cap when 9 months ago it would have been a 5.5 cap, and maybe in a couple months you can buy a 7 cap, and then maybe it's a 7.5. But if you're deploying capital and buying good return assets, that's generating cash flow, covering your debt service ratio, and you're getting a good NOI margin, there's opportunity to continue deploying capital. So the silver lining, I guess, is, we're starting the process of falling prices, and rents are not going down.
Yeah.
They're not even stabilizing. They're still going up. So, that's a good thing for an investor.
Definitely a silver lining. You mentioned a little bit about the Phoenix market. Are there any other markets that, whether you would put a plus sign or a negative sign next to it, any other markets that have been really attention grabbing for you lately?
I mean, due to the increasing tightening on debt, it's getting harder than it was 9, 12, 18 months ago to look at secondary and tertiary markets. So I think, the top 20 markets in the United States are, probably where, it'll still, it's going to be more challenging than it was, but, that's where you're still going to be able to get the debt on board, because, of just the strong fundamentals of, having MSAs, over 1.5 million people, good job base, good job growth, good, schools, all the things that an investor needs. And, those secondary and tertiary markets that have seen also good price appreciation and rent growth, and population growth, a lot of that driven due to the pandemic, work from home. I think there's going to be a little more of a pullback from the debt and equity on wanting to work with investors and focus on those markets temporarily until things shake out. So, it doesn't, again, from a rental perspective, things look good across the board in the top 100 markets in the country. But I think there's certainly going to be some tightening on debt and equity requirements for, kind of secondary and tertiary markets, even though many secondary markets still have very good fundamentals, but, the confidence in primary markets will override, I think, in the short term.
Yeah. At the day job at Lima One Capital, seeing and feeling the same thing, right? Whenever you sit in a credit review committee meeting, there's a little more safety and security in those primary markets and secondary markets still, but there is just a different view, and not to say that it's nixed or falling off the edge of the cliff, but just a little more time spent peeling back the layers the further away from a primary market you get, just to make sure all the I's are dotted and T's crossed.
Well, and for opportunistic investors, the markets where values really skyrocketed are on all the primary markets. So, the assumption would be they will have the greatest retraction in values as well. So there's going to be opportunity to buy right soon. With rents that are arguably at an all-time high, showing no sign of going down. So even if they didn't increase, they'd stay at an all-time high right now, stabilized, over the next couple of years, which is not the prediction. But if that was the case, you're going to be able to buy homes at a lower value, still at all time high rents. So, there is, there's some unique opportunities that are going to show themselves here soon.
Yeah, from a cash flow perspective, and like you said, from an investor's perspective, opportunity to be had. Just have to be arguably more mindful than you had to be a year or two ago, whenever HPA is just saving anybody and everybody, and that was your buffer. The stakes are a little higher now, and to steal your falling knife analogy,
Yeah,
that's a really good picture to paint on. Just got to be a little more cautious and do a little more due diligence.
you do, and it was interesting, because I lived through the last recession. I was that guy in The Big Short walking around half-built subdivisions, wondering what the hell is going on. I mean, it was, I lived through it all, and my background was, heavy in land, and land development for home builders and multifamily developers. And as time went on, and the groups that still had money by 2010, there were a number of investors that just kept sitting on the sideline, even when you could buy, a B-class apartment unit for $25,000 a door, and it was a legitimate 10 cap. The concern there was, well, is this the bottom? And I remember thinking, who cares? You have a 10 cap, right? Like, how does that not work? It doesn't, even if it goes to 15,000 a door, you've got it fully leased at a 10 cap. So, it kind of gets to what I was saying just a little bit ago. If you have capital deployment needs, yeah, you got to be more cautious because you don't know where values are going. But there is going to be a point where the returns just make sense, and maybe you can try not to worry so much about the value. So you're getting your capital out and you're creating and aggregating a portfolio or adding to your portfolio with better returns than you could buy a year ago.
Yeah.
Right.
Yeah. It's like, be prudent. Don't be greedy and Eeyore, right? Like if
Right.
the numbers pencil out and you are a SFR investor who's looking at cash flow, like, be an SFR investor who's looking at cash flow. Make that attribute an appropriate weight to that in your due diligence, right?
Yeah. 100%. And I mean, I remember talking to guys in 2012 and 2013, 2014 that finally started deploying capital, and they all like, God, I wish I would have bought in 2011.
Yeah.
Because they weren't sure when the next cycle was going to end. Which a typical cycle in real estate is 5 to 7 years. So by 2015, we were already at that 7-year mark. Nobody had an idea that things were just going to go up for another 8 years, which they did. So everybody's been riding a wave of success, whether or not they did it on purpose or they just got successful because of market conditions. But now here we are, and this is going to show who was smart recently, or who got maybe a little lucky recently, but more so, you really got to sharpen the pencils now, and you've certainly you've got to be more careful, and the debt and equity is going to hold you to that too. So there's some real restrictions in place now, but like I said, there's going to be opportunity to buy right while the rental market is still rising all over the country.
Yeah, what you were saying reminded me of like trying to time the bottom of the market, right? No different from securities, and that generally speaking, you're not going to be able to time the bottom perfectly. So if you
Right.
see opportunities that pencil out, go for it. Right.
Yeah. Yeah. That's exactly it. You wait for the bottom. Um, you probably won't realize you missed it for at least a year.
Yeah, exactly.
Yeah. And, the maybe riskier, maybe smarter, or whatever you want to call them, those investors that, that find opportunities at cash flow and deploy capital will be buying better returns. And, they'll probably be thankful for it years from today.
Yeah, no doubt. So for people, I've been on, of course, have been on SVN site, other sister companies. Y'all have always great portfolios, great opportunities in there. The data that you provide allows investors to get a really concise bird's eye view of kind of the nuts and bolts of each opportunity that's in there. So for folks who are active investors, which is most everybody listening, tell us how to get there, where we should look, and get in touch with y'all.
Yeah. All of our deals are found at SFRhub.com. It's very simple, registration process. It's free. Just click the register button in the upper right-hand corner, fill in your information, and we'll certify you, and you'll have access to, all of our deals across the country. And then you can, once you see, something that looks interesting, you contact us via email or phone, which is all on there. And we'll send you the doc vault that has, all the more pertinent information, that we're not publicizing, on the site, because we want to make sure that, people sign the NDA, and, we don't want to give away, sellers' information, just for, kind of looking at a deal online. But, once you get our property tape, which we call an ASR, an advanced SFR scrub report, that's a pretty extensive Excel spreadsheet that has all the pertinent information that any investor is going to need to analyze a home. And it's all the same information that the lenders are going to need. So we've really created a product that is, equally favorable to help the buyer understand, the opportunity, as well as to put it right in front of their lender, so their lender can plug all the same information in. And I know we've done this together, multiple times on portfolios with Lima One. So, it's a great tool and resource, and it's something that the industry has, I think, come to respect. And we've been very proud of what we've created. So we put together institutional offering memorandums. So, somebody that really likes to read, they can go through and read all the content. Some investors are more bullet point driven, just want to look at the bullet points, and dig into the T12s and look at the property tape. But we really put a whole doc vault suite together to give whatever type of investor you are. If you're down in the weeds and you want to read every single word, we've got plenty of info for you. If you really just want to dig into the numbers, we'll get you current and actual numbers and pro forma numbers. It's all in there. So very complete package, really structured for institutional investors all the way down to mom and pop investors.
Yeah, as plug and play as it gets, and as someone who lives on the lending side of the fence, and like you said, we've done plenty of deals together. Just as plug and play as it gets for the investor, for the lender, makes life easier, which is always greatly appreciated, for sure.
And that's actually why we created SFRhub.com years ago, because we started in the space in 2014, and it was so apparent back then, the disconnect between buyers and sellers and values, and even anybody knowing what they even had in their portfolio, because so many people, bought homes in foreclosure. So there's really no, due diligence that comes with those. Um, so we were cleaning and verifying data, on these large portfolios back then, kind of the old fashioned manual way. Um, and that's what we created the tech around, to help automate that and use our processes of underwriting to just get through them faster, because it'd take 100 hours to do 100 homes if you really did it right. But the big problem back then was, unlike the commercial world where most people use CoStar, Yardi, there's a few sites, where everybody's kind of gauging off the same information. And, it wasn't 100% correct, because no data is. But, in the SFR world, if you had a buyer comping off the MLS, a seller comping off a Zillow, or Trulia, or just wherever, there were so many different sites, and the values were never the same. So, when we recognize that, we were like, wow, we got to create something that the market recognizes as good data research and valuation, so we can get the buyers and sellers starting a negotiation off the same information. So, this property tape, or ASR, that I mentioned, when we would underwrite a deal and the seller would agree to the pricing, we'd go to market, and now we're sharing good data with the buyers. And now the buyer and the seller are on the same, page. Obviously, a buyer needs to do their own research, and they can go to wherever they want. But at the end of the day, instead of starting with a 16 or 18% price discrepancy, if you got a seller using one data source and a buyer using another, we start them from the exact same playing field. And then, it just made it's proven to make the negotiation easier, because, it's trusted data on both sides.
Yeah, it's very true. I think we're going to bestow upon you the title of SFR Guru.
Oh, yeah, I don't know about that.
Yes, you're too humble, Michael. But thank you so much for carving some time out to kind of walk through the current state of the market and where we see it going. Always enjoy chatting with you, always learn. And yeah, it's interesting times right now and interesting times ahead. Just hunker down, stay prudent, but there's still opportunity out there. So, yeah, I think that's the takeaway.
I'd say keep your pencil sharp, be patient, scrutinize deals heavier than you were before. And you'll see, I mean, there's always silver lining when, there's market corrections, and that silver lining is really finding the gems, or the diamonds in the rough, so to speak. But they're going to be out there, and there will be more of them as time goes on. It's not a bad time to buy at all. It's just a matter of doing more critical due diligence.
That's well put. So thank you, Michael. And I'm sure I'm going to see you sometime here in the next couple months as the conference circuit heats back up. Can't wait for that. But thank you.
I'm sure I'll see you in December at the SFR conference in Scottsdale.
I actually missed that one. I turned 30 and I'm going to be out of the country for a couple weeks. I'm getting old, Michael. So I'm.
Yeah. Well, you enjoy that. That sounds, the SFR conferences are fun, but birthday vacation and out of the country is probably top my list.
Yeah, it's a decent trade-off for this year. So, but I will see you some point soon. And thanks for joining. Much appreciated.
Yeah, I really appreciate it, Dalton. Thank you.
Thanks everybody for listening. Take care.
Yeah, thank you, everybody.